Hello and welcome to the Global View on this Tuesday. Let's take a look at what's going on at a macro level. Benchmark 10-year US Treasury yields have hit 16-year highs as an agreement to avert a partial US government shutdown, reduced demand for debt before a raft of jobs data later this week out of the States. Well, Fed Funds futures traders are now pricing in a 26% chance of an interest rate hike in November and a 45% likelihood of an increase by December. Well, the yield on the US 10-year note rose to 4.7% and the 2-year was above 5.1%. Now, in the latest data, US manufacturing continues to show signs of recovery, with the Purchasing Managers Index increasing to 49 last month, the highest reading in almost a year. While still in contractionary territory, production picked up and employment rebounded. That's according to the ISM survey, while it also showed prices paid for inputs by factories fell considerably. Well, the US dollar index has climbed further after the US government avoided a shutdown, and the manufacturing data supported the view that the Fed will keep interest rates higher for a longer period of time. The Aussie dollar was down more than 1% overnight, currently trading at 63.6 US cents. All right, well, let's now get some international investment ideas with a focus on a family-controlled conglomerate which owns an iconic Australian business. For more, we are joined by Andrew Brown, equity analyst from East 72. Andrew, a very good morning to you again. Thanks for joining us.
No worries.
Interesting, not the first time you've come up with one of these family-held companies in Europe. What before we actually get into the specifics here, why are you attracted to these sort of companies?
Mainly because most of the ones that I've introduced to the base here have been sort of fourth, fifth, sixth generation companies. So they've got real experience of handling business through economic cycles. And I think that's going to be really important over the next 2 to 3 years. Secondly, most of them manage their businesses extraordinarily well. They don't waste money. They're very good at capital allocation in most cases. They're not worried about selling a business if it's got value to somebody else, and they're certainly not worried about buying businesses. And they tend to be very counter-cyclical. They hold cash when other people are loaded up with debt, and vice versa. So when there's distressed assets available, then they're ready to pounce. So that's really why I get interested in those companies. But I do try to make sure that they've been through more than just 1 or 2 generations.
Okay, well, that said then, let's get specific with the company you're looking at today, which is Belgian-based.
Yeah.
Builds, cars and the like, and I guess maybe a focus on EVs, but tell us the setup for the company and obviously its history.
Yeah, its history. It's actually founded in 1805, so it's been through plenty of generations. The company's called D'Ieteren. It's about an $8.5 billion euro company. It's controlled effectively by the D'Ieteren family. They have about 63% of the shares and the votes. It was started as a coach builder in 1805, so the kind of things you see the kings and queens loitering around in still today. It was a bodybuilder for cars at one stage, but it's basically got out of all that. And its major holding is a 50% stake in the world leader in auto glass replacement. And of course, the Australian company that it owns is Windscreens O'Brien. These are really great businesses because if you're the market leader, you have an input into the insurance industry because the insurers basically authorize you to replace. You can get out with your network of vans and other people, so you're the most obvious person to ring. I mean, if your windscreen busts, you ring Windscreen O'Brien, don't you? It's easy. They've got vans everywhere. They can get to you quickly. They've got every kind of glass available, and they've got the technology and skills to put it in. Well, that's exactly the same worldwide with this company, where 60% of the business is in North America. So they've got brands like Auto Glass in particular. They bought it in 1999. They only own 50%. They sold it down in 2018 to various investment firms. But this business is going really, really strongly at the moment because obviously car sales have picked up very strongly over the past 2 or 3 years. There's more traffic on the road, so that means more accidents, more break-ins, more everything that requires windscreen replacement. Plus, they're reasonably, I'm not saying they're inflation proof, but they've got reasonable hedging against inflation as well. So the profits in this company in the first half of the year are up about 50%, and they've been freeing up significant amounts of money from the half holding to pay back to the parent. They took a 570 million euro dividend out of it in the first half.
So, well, you say profits up 50% in the first
Yeah.
half. Why that dramatic move?
A few things, basically, particularly in Belron, which is the name of the holding company for the auto glass replacement. It's basically just there's more cars on the road, there's more driving around, so there's more activity. They have had some small acquisitions, and their margins have gone up, which is really the critical thing. They've been able to reprice, as you're well aware. A few people in the auto industry were caught out by cost price inflation. They've caught up with that now, and so that's why the profits have been very, very strong. Just to give you an idea and give you some context, the 100% of Belron is about a €6 billion business globally. So this is no small fry at all. We think Belron, we think the stake that D'Ieteren own in Belron's worth somewhere around 4.3, 4.5 billion euros alone.
All right. So I gather it's not. Is it just windscreens and glass replacement, or is it sort of more? Is it sort of spare parts essentially as well?
No, there's a lot more to D'Ieteren than just the half stake in Belron, which is the windscreens.
Yeah.
First of all, the next big business is the VW distributor in Belgium. I've had the pleasure of visiting some assets owned by the VW distributor in Holland, and they are richer than Croesus, so I can tell you. Those assets were Argentinian wineries. But these guys, Belgian car sales are recovering very strongly, as they are, of course, around the world. So they'll be over 500,000 for the first time since 2019. D'Ieteren have about a 23% market share. It's a strange market, Belgium. 2/3 of D'Ieteren sales in Belgium are for business. And there's a lot of EVs and hybrids, as you can imagine, in Europe. So VW and Audi are really well represented. Profits this year in that business are up 50% in the first half as well. And the bounce is likely to continue because they're dragging cars from VW who are delivering them in spades. If you saw VW's half year earnings were pretty robust, despite what's happened to the share price, and deliveries are up. So that there's still a fair bit of this cycle to go, and we think that business is worth sort of about 1.7 billion euros. They got a couple of other businesses. One got badly impacted in the first half. They own 40% of materials handling business for forklifts. It's called TVH. They're the market leader globally for replacement parts for forklifts and also for construction handling equipment. Things like scissor lifts and stuff like that. They actually had a cyber attack in March, and it basically shut them down for a month. So they're sort of getting over that now. So there will be a strong recovery next year. And the final part of the business is something called Parts Holding Europe, which they pretty much wholly own. It's basically an independent parts distributor, very focused on France, about 2/3 of business there. And it's rebounding very well because, of course, the same factors at work. People are driving again. Car sales have been reasonably robust, more cars on the road. So you add all that lot up, and the parent company level, because it's a holding company, the parent company's got well over 600 million euros of cash, and they've got some loans to the other company, which we don't talk about very much because it was a pretty poor acquisition they made back in 2016, which is Moleskine, and that's stationary, as you all know.
Right.
And when it's with auto parts, none of us know.
Okay, so Andrew, how would you invest in the business?
You can basically buy stock in it. It's listed on the Belgian stock market, so it's another one of those Euronext markets. The stock code is rather unfortunate. It's DIE.BR for Brussels. So you can buy stock in it on any one of the major platforms that you can buy European stocks through. It's basically trading sort of around mid-range over the last 12 months. It bounced reasonably hard after the interim results because they were better than expected, and it gave a profit upgrade as well. The trick with it, I think, Andrew, is that there's strong profit growth to come. It's got plenty of liquidity. It's consistently buying back stock, but it's a complicated company, obviously, with its biggest business half owned, another one 40% owned, then some wholly owned. So it's not easy to analyse particularly. But when we strip it away, we think the sort of core earnings base is a PE of about 13 for some really high quality businesses. And they might eventually spin off the rest of Belron as well. There's a chance, having obviously sold part of it, and it's had a strong profit recovery since then. So who knows? These people are proactive.
All right, Andrew, you've done it again, delivered one of those more obscure companies, but obviously worthwhile taking a look at, particularly has a stake in some of the well-known businesses that we know here. Thanks for joining us from East 72.
Thank you.
Andrew Brown there. All right, that is the global view for this Tuesday. Just to check of the market, as I've mentioned earlier, we are expecting to open with some heavy selling there, with SPI futures off 1 1/8%. Stay with us, the open is just around the corner.